Hello and thanks for joining us at interest.co.nz. I'm Janae Tibshirani and today I'm joined by the Assistant Reserve Bank Governor, Christian Hawkesby. Thanks for joining us, Christian.
Yeah, good morning.
Right, so yesterday the Reserve Bank once again surprised markets by keeping the OCR on hold at 1%. Was this decision more a matter of the economic conditions not getting worse than a matter of the economy improving?
Yeah, well, we looked at it and just thought we had seen back in August that we thought we needed more stimulus in the economy, and we took a decision back in August to get on with it and provide 50 basis points in quick measure. And we've had an opportunity since then just to see how that's working its way through the economy. And our take was that there have been unders and overs since August. Some things have been a bit softer, like domestic economic activity, global growth a little bit softer, but some things have been stronger. So we've had more stimulus through the exchange rate, we've had lower retail interest rates working their way through, strong terms of trade. So we thought the data had been pretty balanced, which really just puts us in a position to be able to continue to monitor things from here.
In terms of that, the stimulatory effect of that 50 basis point cut, to what extent has that really come through the housing market?
Well, the thing for us is that interest rates are a pretty blunt tool and they work their way through the economy through a number of channels. Already talked a bit about the exchange rate, which has been really important this year. The housing market is another channel, an inevitable channel, and the thing that we're watching for particularly there is the relationship between consumption growth and house prices, which is a pretty strong relationship. Consumption tends to pick up as house price inflation picks up, and we've seen some early signs of that already, and so we're in a position to just see how that unfolds from here.
How concerned are you though that actually too much stimulus might come from house price increases, which then has that sort of wealth effect? People feel like they have more money and go out and spend. Are you concerned that too much will come through that channel versus, say, business investment?
Yeah, the challenge we have is that we don't have control over which channel is going to be the strongest. So we monitor how things are playing out. What we also do is that we're conscious that for the Monetary Policy Committee, our focus needs to be on inflation and employment, and so that's first and foremost what we're looking at and what we're setting the interest rates to try and achieve. We know that we also have to be conscious of financial stability implications, so as a committee we do discuss that in the record of the meeting. I thought there was a good capture of that discussion. We're also conscious that at the Reserve Bank, we also have a separate Financial Stability Committee that has responsibility for financial stability and has tools that they can use, including loan to values and prudential regulation of banks. So we take that into account as well.
Yeah, so speaking of those LVRs, they're going to be... a new financial stability report is out next month, and at that point the Reserve Bank will have the ability to change possibly those LVRs. How much of a bearing has that had on the OCR decision? Yeah,
so we've got a financial stability report 27th of November, so later this month. And so that's every 6 months that we have that publication, and it's the same frequency that we review our loan to value restrictions. And so we'll be looking at all the usual things we do there to give a sense of should we still have those, what level should they be at. Credit growth and asset price inflation are one of the few of the things that go into those considerations, but primarily they're about not about asset prices, but about the resilience of the financial system and the resilience of the household sector to be able to weather different types of conditions. So it'll be those measures that give us a sense of how resilient the banking system is and how resilient the household sector is that will drive those decisions.
Do you think they've become more resilient in the last 6 months?
We'll sit down and look through the whole plethora of information, but it's a slow moving, that sort of resilience question and that question about financial stability is a more slow moving one, and that's why we tend to review it on a lower frequency than we do 6 weekly for the official cash rate.
Sure. Bank economists are saying that because the Reserve Bank has kept interest rates on hold, that might give it a bit more of an ability to ease those LVR restrictions, so that, just to people listening, that means it's easy. Banks have more ability to lend on for mortgages. So what would you say to that comment?
We don't really get into the fine-tuning of how to move one lever so we can move the other lever. We just tend to take them each into consideration separately, and we'll do that later in the month.
Okay, sure. Christian, the decision once again surprised markets, and we saw swap rates really spike yesterday, and some economists said that this could be an indicator that mortgage rates might go up a wee bit. Do you think this could happen?
Well, I guess firstly we were conscious that the market was not, everyone in the market wasn't expecting us to stay on hold. So we were conscious that there was scope for market rates and the exchange rate to rise somewhat in response to our decision. So that was something we were conscious of when we made the call. What we're also aware of, though, is that mortgage rates have moved a long way over the course of this year, down 50 to 150 basis points. So we've had a bit of volatility over the last 24 hours. Things will settle from there.
Were you surprised, though, by just how much those swaps went up?
I think the swap rates actually overshot initially. So from what I saw, they moved up very sharply and then fell back somewhat. And I think things will just continue to readjust as people reassess what are the chances of the next move in the official cash rate. Within our own projections, we have half a cut factored into our own projections. So there is sort of some probability as we see it, and we've made it very clear that we're willing to do what's required to meet our objectives, and if that's cutting the official cash rate from here, that's something we will be open to considering, but it will be driven by the economic information. It will be driven by what's our confidence around hitting our inflation target and our employment goals.
Okay. Look, I'd just like to talk about fiscal stimulus now, the theme in the press conference yesterday. A few of us noted perhaps that the tone the Reserve Bank, the committee and perhaps the governor as well, was using in terms of calling for the government to spend more money to stimulate the economy had sort of toned back a bit. Now, we can discuss what's meant by that and all that, but a theory that has emerged is that the Reserve Bank knows something about what the government is going to announce at budget next year, or fiscal stimulus in the pipeline that perhaps we don't know. Is this the case?
Well, I can just refute that very easily. We take into account the published information, and we're very strict around the way that we do that. We know that if we try and come up with our own fiscal projections or our own ideas about where things are going to go, it will just fuel speculation that we know something that we don't. So we prefer just to play straight bat, use the government's fiscal numbers. They're what goes into our projections. My take on this sort of discussion is one of the things it highlights is the way that we do our communication. So the way that we write our press release and the way that we write our record of the meeting. A lot of other central banks tend to be wedded to what they said last time and tweak a few words and be very sensitive about the way markets might interpret a few words being changed. We tend to write things from scratch to reflect what the discussion was. So sometimes the words and the statements will change, and it's not a big deal. It's not a particular point we're trying to make. With regards to fiscal policy, we think we've had a good discussion about it already. We feel like our view on it's very clear publicly, so there was no need to put great emphasis on it this time.
Do you think that what's in the previous budget, that the money that has been allocated towards new spending, so around welfare and infrastructure, do you think that is at a sufficient level?
What we've said from our perspective is that we would welcome more fiscal stimulus in the sense that from our perspective it would be helpful for us hitting our inflation target. We're trying to hit it from below. More fiscal stimulus would help that. But what we've also made clear is that we respect the operational independence of the Treasury and the Minister of Finance to set the tools that they have control over, in the same way that they respect our operational independence to set monetary policy and interest rates. So we're very conscious of that.
Sure. Christian Hawkesby, thank you so much for your time. Really appreciate it. And I'm Janae Tibshirani from interest.co.nz.